Now, when we look at short-term credit, they talk about three different types. So the types of short-term credit is, so first of all, there's trade credit, which is like accounts payable. And so if you want to finance your purchases, you can do it by getting suppliers to pay you later, or paying suppliers later. The second is a short-term loan, and this would be from a bank with like fixed payments. Okay, and it's the real difference between long-term debt and short-term is this is going to be paid relatively quickly, where long-term debt can go for years or even decades. And then the last one is a line of credit, which is usually what most companies will use. So it's kind of like having a credit card available. Well, the rates are obviously higher, but they have access to, say, $1 million as a line of credit. If they need it for a month, they take it, pay interest, and then repay it as they don't need it. Now, if we use trade credit as a method of financing, we have to look how much it's going to be. And we can calculate the cost of it. If they say it's free, that you don't have to pay for 30 days, then that's simple. You take it, 30 days for free. What if they say they'll give you a discount for paying early? Then in essence, you are paying a credit by passing on the discount. So here's a good example. You can buy a product for $1,000 and the supplier is giving you payment terms of $210 net 30. What that means is you get a 2% discount if you pay in 10 days. If you don't pay in 10 days, you have until 30 days, but you got to pay the full amount. Okay, so the first question is, what's the annual cost of credit if you forgo the discount? So the textbook does it one way. I'm going to use a formula which I think is a bit simpler. So you're looking here at the annual cost, which is just a percentage. And the annual cost is if you forgo the discount. The discount to pay early. You decide you're going to take the whole thing. So the amount is calculated by 1 plus discount percentage divided by 100% minus the discount percentage to the power of 365 over n, and all of that will be minus 1. N in this case is the number of days of extra credit. So what is that in this case? So let's, look at each of these numbers. What's the discount? If we take the discount, it's 2% if you pay early. Let's write it as a decimal, so 0.02. Okay. What's the number of days of extra credit? Instead of paying in 30 days, or instead of paying in 10 days, you're paying in 30. So you're getting 20 extra days of credit. So let's substitute this in. The annual cost is equal to 1 plus 0.02 over 1 minus 0.02 to the power of 365 over 20 minus 1. So this works out to 45%, which is very expensive. And so it's costing you interest of 45% by skipping the discount. So let's go to the second question. What factors would you consider when in determining whether to take the discount or not? The factors that you would consider would be things like, what is your cost of capital? So clearly you would want to do it, if your cost of capital is 10%, you don't want to be financing at 45. The other thing is, what is the line of credit rate that your company has? Okay, so if you can get cash for, say, 10%, or 8%, whatever. As long as the number is below 45, you would be better off taking it on a line of credit, taking the discount, and then repaying the line of credit at the end of 30 days when you were planning to pay your payable anyways.